Welcome to the City of Dunwoody's training module on Georgia law for occupation taxes and regulatory fees. Most of this presentation will concentrate on the ins and outs of occupation taxes, while the simpler subject of regulatory fees will be covered mostly toward the end of the presentation. With respect to regulatory fees, the law mandates that these fees may not serve the purpose of raising revenue. Instead, a local government may impose a regulatory fee to cover the cost of regulating various businesses and activities. An occupation tax is a tax enacted by a local government for the purpose of raising revenue. It is a tax imposed on persons, partnerships, corporations, or other entities. Local governments may provide by local ordinance or resolution for the levy, assessment, and collection of an occupation tax, but they are not required to do so. Local governments must conduct a hearing prior to adopting any ordinance or resolution concerning an occupation tax. The occupation tax may include an administrative fee to cover the cost of administering the tax. Occupation tax ordinances may also include remedies for failure to pay taxes in a timely manner. Article 9, Section 4, Paragraph 1 of the Georgia Constitution authorizes local governments to levy and collect taxes and fees within the local government's limits. Among those taxes permitted by the General Assembly through statutory law are occupation taxes levied on businesses and practitioners, and regulatory fees assessed to recover the cost of regulating business activities. The purpose of this presentation is to familiarize city officials with some of the important basics in the area of occupation taxation and regulatory fees. Because of the complexities of the laws concerning these subjects, it is not advisable to adopt an occupation tax or regulatory fee ordinance without consultation with legal counsel. In 1993, the Georgia General Assembly passed House Bill 362, substantially revising the law authorizing cities and counties to impose business and occupation taxes and regulatory fees. This law was again amended significantly in 1995 and has received minor alterations in recent years as well. The law is codified in OCGA Section 48-13-5 through OCGA Section 48-13-29. Under the revised law, a city or county may levy and collect occupation taxes on businesses and practitioners that have an office or location within the local government jurisdiction. These occupation taxes may be used to raise revenue for the local government. Significantly, the law uses the term occupation tax rather than business license. As a result, local governments now provide a business with an occupation tax certificate signifying the payment of annual occupation taxes instead of a business license. While some local government ordinances still refer to business licenses, the term is old-fashioned and is often confusing to local businesses as well as to city administrators trying to comply with current state law. When dealing with the public and even elected officials, always attempt to make a point of using the term occupation tax rather than the term business license, even though the occupation tax may still be publicly perceived as a business license. In time, the new term will become the norm. There is only one purpose for an occupation tax and only one purpose for a regulatory fee. However, there are many benefits when occupation taxes and regulatory fees are levied wisely and assessed and collected fairly and accurately. The only purpose of an occupation tax is to collect revenue for the local government imposing the tax. Taxes are important revenue sources for local governments. The money generated helps cover administrative costs, police protection, and many other community services. The only purpose of a regulatory fee is to cover the cost of the regulatory activities of the local government. One of the major benefits of occupation taxes is that they help provide information on the various types of business operations that may be within a local government's jurisdiction. In most areas in Georgia, it is illegal to conduct business without a proper occupation tax certificate. To receive an occupation tax certificate, businesses are typically required to at least register their name, location of operation, and describe their dominant business activity to their governing authority. Keep in mind, however, the payment of occupation taxes does not take precedent to the practice of any profession, trade, or calling, nor is it meant to regulate business in any way. Zoning and other permitting should not be considered for collecting the tax. Again, the business is paying a tax whose sole purpose is to generate revenue for the local government and not to regulate in any manner. Another benefit of occupation taxes is their potential to assist the local government to maintain and assess other local ordinances, such as zoning. Compliance with local zoning ordinance is typically verified when a business registers their proposed location of operation. Occupation tax staff may collect the tax from a business and turn over that information to other departments for zoning enforcement issues. As occupation taxes and regulatory fees are enacted and collected, a wealth of information relating to the local business community is also collected. This information provides an excellent database resource for the community. Most information provided on an application for an occupation tax certificate is available for open records request and is used by employers, sales agents, and developers. Before releasing information, though, be sure specific items such as gross receipts are omitted from disclosure as required by law. Occupation taxes and regulatory fees also provide an additional level of protection to citizens and visitors from fraud and misrepresentation. For starters, as mentioned before, businesses are typically required to register their name, location of operation, and describe their dominant business activity to their governing authority in order to receive an occupation tax certificate. This will help to keep law enforcement and regulatory agencies up to date and aware of the landscape of the local business community. Georgia law permits local government to assess occupation taxes on both in-state and out-of-state businesses, provided that certain criteria are met. Georgia law does not, however, authorize local governments to levy any tax on an individual merely for the privilege of working within or being employed within the limits of the local government's jurisdiction. For example, City X may not charge an occupation tax to a plumber or electrician who provides services within City X, but who does not have an office or location within City X. City X may, however, still assess regulatory fees on the plumber or electrician to cover the costs of regulating his or her business activities within the city limits. Cities and counties may impose an occupation tax on businesses and practitioners that have one or more locations or offices inside the local government's jurisdiction. A location or office may be defined as any structure where a business profession or occupation is conducted, or any vehicle where a business profession or occupation is conducted. The following places would not be considered an office or location for the purpose of assessing occupation taxes: a temporary or construction worksite serving a single customer or project, a vehicle used for sales or delivery by a business or practitioner that already has a separate location or office, a renter's or lessor's property that is the location of rented or leased personal property of another is not an office or location for the personal property's owner or lessor. Property that is rented or leased to another unless the owner conducts business on the site. Note that leased real property is not an office or location for the real property's owner or lessor, unless the owner or lessor conducts business on the property other than merely maintaining the property or showing the property to prospective lessees. Thus, a local government may not levy an occupation tax on the business of operating an apartment complex if the leasing or management office is not also located within that local government's jurisdiction. If certain criteria are met, local governments may impose occupation taxes on out-of-state businesses. Occupation taxes may be imposed on businesses and practitioners of professions and occupations with no location or office in Georgia if the business or practitioner has one or more employees or agents who exert substantial effort inside the local government's jurisdiction in order to solicit business or serve customers. Or the business or practitioner owns income-generating property, personal or real, that is located within the local government's jurisdiction. It should be noted only the local government for the city or county in which the largest dollar volume of business or service is done may impose an occupation tax on an out-of-state business or practitioner. For example, if an out-of-state business exerts substantial efforts in City X, accounting for $100,000 in business, but also exerts substantial efforts in City Y, accounting for $200,000 in business, that business would only be required to pay an occupation tax to City Y. Each local government may obtain information concerning the location of a business's or practitioner's largest dollar volume of business from that business or practitioner. If an out-of-state business or practitioner provides proof of payment to another state of occupation taxes owed to local governments in Georgia, when that other state taxes the business's or practitioner's sales or services in Georgia, the business or practitioner will be exempt from occupation tax in Georgia. Until 1993, Georgia law prohibited local governments from collecting an occupation tax or license fee from traveling salespersons unless goods were delivered at the time of the sale. Additionally, it prohibited local governments from levying an occupation tax on merchants or dealers or on their employees who deliver previously ordered merchandise. This prohibition was repealed in 1993, so that traveling salespersons and other individuals who conduct business within a local government's jurisdiction may be taxed if they have a location within that jurisdiction. Essentially, a salesperson who delivers goods previously ordered from a business without an office or location in a jurisdiction is not subject to occupation tax based on the delivery. Likewise, a salesperson who takes orders but does not deliver goods is not subject to occupation taxation based on the sale. However, if a person sells and delivers goods from a vehicle, the vehicle may constitute a location for occupation tax purposes, thereby subjecting the salesperson to occupation taxes. If a business has employees who do business in Georgia, such as traveling salespersons, but does not have a location in Georgia, that business is taxed as an out-of-state business. Accordingly, if an out-of-state business has employees who serve as door-to-door salespersons, and those salespersons exert substantial efforts for the purpose of soliciting business or serving customers or clients, the business might be subject to a local government's occupation tax. Again, only the local government in which the largest dollar volume of business is conducted or service is provided may collect occupation tax from an out-of-state business. Local government officials should be aware that this interpretation of the occupation tax law may be subjected to a constitutional challenge for allegedly interfering with interstate commerce. As a general rule, local governments may not levy or collect any fixed amount license, occupation, or professional tax on real estate brokers, except at a real estate broker's principal or branch office. However, the law permits a municipality or county that levies a general occupation tax on a gross receipts basis to levy and collect an occupation tax on real estate brokers transacting business within the boundaries of the local government. The tax must be based on gross receipts derived from transactions with respect to property located within the boundaries of the local government. Local governments may not impose occupation taxes on insurance companies. Instead, state law permits municipalities to impose and collect license fees upon insurance companies ranging from $15 annually to $150 annually. A full list and explanation of the license fees is on the screen now. A city may impose an annual license fee on each insurance company doing business within the city limits. A city may also levy an annual license fee in the same amount for each additional business location of an insurance company within that city. Additionally, a city may levy an annual license fee of $10 or 35% of the given schedule on an insurance company for each additional business location that is not otherwise subject to an annual municipal license fee. This second license fee only applies to a company that is operated and maintained by a business organization that lends money or transacts sales involving term financing and, in connection with the loans or sales involving term financing, offers, solicits, or takes applications for insurance through a licensed agent of the insurance company. Cities and counties may each levy and collect a business license tax from depository financial institutions having an office located within their respective jurisdiction. The tax rate may not exceed 0.25% of the Georgia gross receipts of the depository financial institutions. Cities and counties may provide that the minimum annual amount of this tax on any depository financial institution may not exceed $1,000. State law exempts a number of persons, businesses, and services from local occupation taxation. Many of these exemptions are applicable statewide. However, some are applicable at the option of each taxing local government. A fairly extensive list of the people and businesses exempted from occupation taxes by Georgia law is given on your screen right now. Some of these people and businesses include disabled veterans who were injured during service, blind persons, state or local authorities, nonprofit organizations, some agricultural businesses, and motor common carriers. A local government may provide an exemption or reduction in occupation tax or a credit against occupation tax owed to one or more types of businesses or practitioners in order to promote economic development or attract and maintain certain selected types of businesses or practitioners. It is important to note these exemptions, reductions, and credits may not be arbitrary and capricious. In order to avoid any arbitrary and capricious claims, a local government may wish to state in the ordinance the specific economic benefits expected as a result of providing the occupation tax exemptions, reductions, or credits. The following non-exhaustive list provides examples of occupation tax exemptions, reductions, and credits. Exemptions may be made by setting dollar amount limitations on the total amount of tax, either by criterion or a combination of criteria used for classification. A local government providing an absolute dollar amount limitation may collect the tax only once on each business or practitioner, regardless of the number of offices or locations a business or practitioner has in the jurisdiction. Tax credits may be offered for the creation or retention of jobs. Tax credits may also be set up in exchange for other taxes paid to the local government, such as ad valorem taxes. A tax exemption or reduction may be made for sales to customers located outside the jurisdiction of the local government. A credit or rebate may be given to businesses or practitioners who paid occupation taxes the previous year. Exemptions may also be made by setting a limit on the dollar or percentage increase in tax from a base year to a subsequent year. This limit must be made applicable to new businesses and practitioners by inputting the gross receipts profitability ratio or number of employees of the subsequent year to the base year in determining the tax for the base year, tax for the subsequent year, and the increase in tax. As a final example, a credit or reduction may be established as an adjustment for seasonal and other fluctuations in the number of employees. In order to comply with uniformity requirements, local governments must classify all businesses or practitioners by the same criterion or combination of criteria. Local governments may classify businesses and practitioners and may assess different taxes on different classes of businesses and practitioners. A city must use one or more of the following 4 criteria for classification: number of employees, profitability ratio, gross receipts, or flat fee. The first method of classification is number of employees. Local governments may tax based on the number of employees working for a business. This criterion is computed on a full-time position basis or full-time position equivalent basis. An employee who works 40 hours or more a week is considered a full-time employee. The average weekly hours of employees who work less than 40 hours weekly are added together and divided by 40 to produce full-time position equivalents. For example, if a business has 10 employees, all of whom work 36 hours a week, the total number of hours worked would be 360 hours per week. The total number of hours worked, 360, divided by 40, equals the equivalent of 9 full-time jobs. Thus, instead of taxing this business for having 10 employees, the local government would tax based on 9 full-time employees. Local governments using this classification may adopt more than one rate of taxation per employee. A local government may choose to utilize a regressive rate table in which the per-employee occupation tax decreases as the number of employees increases. For example, a local government may wish to tax businesses with fewer than 10 full-time employees at the rate of $50 per employee, businesses with 11 to 50 full-time employees at the rate of $40 per employee, and businesses with more than 50 employees at the rate of $25 per employee. According to Georgia law, an employee is a person who works under the direction and supervision of an employer if that employer withholds FICA federal income tax or state income tax from the employee's wages, or issues a W-2 form but not a 1099 tax form to the person in order to document compensation. An employee may also be a contract employee who works for one business under the terms of a contract or agreement with the recruiting business. In this scenario, the person is an employee of the business issuing the person a W-2 form. Note, while a 1099 contractor is not an employee, a 1099 contractor is a legally separate business. A 1099 contractor may be required to have their own occupation tax certificate. This is very relevant in certain industries, such as salons and real estate, where staff is often independent contractors. Using the second method of classification, local governments may use the profitability ratio for consideration of classification for the type of business, profession, or occupation as measured by the nationwide averages from statistics, classifications, or other information published by the United States Office of Management and Budget, the IRS, or successor agencies. Profitability ratio is determined by dividing net income by gross receipts. These data may be found on the Internal Revenue Service website or in other IRS statistics of income documents. Many local governments use the code issued by the North American Industry Classification System, or NAICS, to classify businesses into subgroups. This classification system may be found on the NAICS page of the United States Census Bureau website. Local governments using the profitability ratio criterion or the gross receipts criterion are required to rank the businesses and practitioners according to the profitability ratio. Prior to setting the rates of taxation for each classification, a local government must establish profitability ratios that do not overlap. A local government may not apply to any classification a rate of taxation higher than the rate applied to another classification that includes a business or practitioner with a higher profitability ratio. In other words, a local government may not tax a business with a low profitability ratio at a higher tax rate than it taxes those with a higher profitability ratio. It is important to note also, it is not a good idea to simply keep the same tax class for a business code every year. Cycles and economies change, and leaving a business in the same class can make your community's occupation tax illegal. As an exception to this rule, a local government may apply different rates of taxation within the same profitability ratio by dollar amount gross receipts. A local government using different rates of taxation within the same profitability classification must use the same dollar ranges of gross receipts for each profitability classification. Under the third method of classification, local governments may base their occupation tax on the gross receipts of a business or practitioner in combination with the profitability ratio for the business or practitioner. Local governments using the gross receipts classification may limit the geographic area in which gross receipts will be taxed by the local government. Included as gross receipts would be total income, gains from trading in stocks, bonds, capital assets, or instruments of indebtedness, proceeds from commissions on the sale of property, goods, or services, proceeds from fees charged for services rendered, and proceeds from rent, interest, royalty, or dividend income. Things not to be included as gross receipts would be sales, use, or excise taxes, sales returns, allowances, and discounts, certain interorganizational sales or transfers, payments made to a subcontractor or independent agent for services that contributed to the gross receipts, governmental and foundation grants, charitable contributions, or interest income derived from these funds received by a nonprofit organization that employs salaried practitioners if the funds constitute 80% or more of the organization receipts. And lastly, proceeds from sales of goods or services that are delivered to or received by customers who are outside the state at the time of delivery. The fourth and final method of classification is flat fee. The flat fee classification must be applied uniformly to all businesses and practitioners of professions and occupations. Under this classification, each business or practitioner pays the same amount of tax for each office or location. Certain businesses and practitioners of occupations are authorized by state law to choose between the local government's method of classification for occupation taxes and a fee set by the local government. This fee may not exceed $400 per practitioner who is licensed to provide the service. This tax must be paid at the practitioner's office or location. A local government may not require a practitioner paying this set fee to provide information on the gross receipts of the business or practitioner. Businesses and practitioners that qualify for this option under the occupation tax law are known as the 400 Club. 400 Club members include lawyers, physicians, osteopaths, chiropractors, podiatrists, dentists, optometrists, psychologists, veterinarians, landscape architects, land surveyors, practitioners of physiotherapy, public accountants, embalmers, funeral directors, civil, mechanical, hydraulic, or electrical engineers, architects, and marriage and family counselors, social workers, and professional counselors. There are many special circumstances which can occur in the development and implementation of occupation taxes. One of these special circumstances is levying an occupation tax on businesses or practitioners with more than one type of service or product. The law provides two methods for dealing with this situation. First, a local government that does not use the gross receipts classification must classify the business or practitioner according to the dominant service or product, unless the local government only uses the flat fee classification. Second, a local government that does use the gross receipts method of taxation must include in its local ordinance or resolution for occupation taxes whether the local government will classify the entire gross receipts by dominant service or product, or apportion the gross receipts by category or service in proportion to the gross receipts generated by each service or product. If the local government chooses the apportionment method, the government must tax each portion of the gross receipts according to the profitability ratio for that type of business. The government must then add the tax for all portions to determine the total occupation tax. Georgia law also imposes special requirements on the collection of occupation taxes based on gross receipts or the number of employees imposed on businesses or practitioners with multiple locations in Georgia. With respect to imposing occupation taxes on a business or practitioner with a location or office in more than one jurisdiction, local governments using gross receipts must allocate the gross receipts of the business or practitioner in one of two ways. First, if the business or practitioner can reasonably allocate the dollar amount of its gross receipts to one or more of its locations or offices based on the product manufactured, sales, or other services, each local government may tax the gross receipts generated by the location or office inside the jurisdiction of that local government. If the business or practitioner cannot reasonably allocate the dollar amount of its gross receipts among its locations or offices, the business must divide its total gross receipts reported in Georgia by the number of locations or offices that contributed to those gross receipts. The business must then allocate an equal percentage of its gross receipts to each location or office. Local governments that use the number of employees to determine occupation taxation may tax the number of the business's employees who work inside the local government's jurisdiction. If an employee works for the same business in more than one jurisdiction, the city or county in which the employee works the most in a calendar year may count the employee for occupation tax purposes. Again, this criterion is based on a full-time employee or full-time employee equivalent basis, with a 40-hour work week constituting a full-time position. Taxation of attorneys is tricky. In April 2003, the Georgia Supreme Court ruled in City of Atlanta v. Barnes that City of Atlanta's occupation tax ordinance operated as an unconstitutional precondition to the practice of law. Following its ruling in Sexton v. City of Jonesboro, the court determined that the ordinance required payment of the occupation tax prior to the commencement of business, and that the possibility of incarceration as a result of failure to pay the tax was an impediment to the practice of law. While the court did not say that local governments could not impose a lawful occupation tax on attorneys, it failed to provide any insight on how a local government could impose such a tax. Suggested possible mechanisms through which to impose the tax without acting as a precondition to the practice of law include imposing the occupation tax in arrears, or granting a local occupation tax exemption or credit to attorneys as part of a plan for economic development, or attracting, encouraging, or maintaining selected types of businesses or practitioners. Unless specifically stated in the ordinance, all occupation taxes are due and payable annually within 30 days following January 1st, or on such other date as is specified in the local government ordinance. If a person begins business on any other date, the tax will be due and payable 30 days following the commencement of the business. If a business opens on or after July 1st of any year, the occupation tax for the rest of the year will be 50% of the tax imposed for the entire year. The law provides two exceptions to this rule. First, a local government that taxes based on gross receipts may levy its customary rate of the gross receipts of the business from the date the business opens. For example, if a business opens on August 15th of a year, that business may be taxed on its anticipated gross receipts for the rest of the calendar year. Second, a practitioner who elects to pay occupation tax as part of the 400 Club must pay the full amount assessed by the local government. Administrative fees charged along with occupation taxes are not offset or reduced based on the time of year in which the business commences. Prior to pursuing the collection of delinquent occupation taxes, a local government should ensure that the collection procedure is clearly articulated in its occupation tax ordinance. From a practical standpoint, a local government may wish to give delinquent taxpayers a second written notice sometime shortly after the tax is due. Should the business still neglect to pay the tax, the city may follow the written notice with a personal visit or telephone call to the place of business. Accounts of these visits and telephone calls should be recorded in writing. By taking these steps, a local government demonstrates its good faith efforts to collect the tax. Should the delinquent taxpayer still neglect to pay the occupation tax, along with any delinquency fees within a specified period of time, the local government may choose to proceed to court, where the matter may be processed in the same manner as other code enforcement violations. A local government may include a penalty for failure to properly pay occupation taxes in its occupation tax ordinance. Local governments may provide in their ordinances for interest on delinquent occupation taxes, regulatory fees, and administrative fees at a rate not to exceed 1.5% per month. The court with jurisdiction to enforce local government ordinances may, if authorized by the local ordinance, impose a civil fine for failure to pay the occupation tax or regulatory fee. This fine may not exceed $500 and may be enforced by the contempt power of the court. Under general state law, if any occupation tax or license fee remains due and unpaid for 90 days from the due date of the tax or fee, the person liable for the tax or fee is subject to a penalty of 10% of the tax or fee due. In addition to these remedies for failure to pay occupation taxes and regulatory fees, the officer charged with the collection of the tax or fee must issue executions against the delinquent taxpayers for any or all of the following: the amount of the taxes or fees due when the taxes or fees become due, or any penalty of 10% of the tax or fee due and any interest imposed by the local ordinance. A local government may use an entry of nulla bona as a means of compelling delinquent taxpayers to pay their occupation taxes. An entry of nulla bona may be made when the governing authority determines that the defaulting party does not have any goods on which the local government may levy to enforce payment. When an entry of nulla bona has been entered against any person defaulting on an occupation tax, the person against whom the entry is made may not collect any fees or charges whatever for services rendered after the entry of the nulla bona. If, at any time after the entry of nulla bona has been made, the delinquent taxpayer pays the tax in full, together with all interest and costs accrued on the tax, the taxpayer may collect any fees and charges due as though he or she had never defaulted in the payment of the tax. At the request of a local government, a business or practitioner with a location in more than one jurisdiction must provide the local government with financial information to allocate the gross receipts of the business, and information concerning the allocation of the business's gross receipts by other local governments. Generally, information on gross receipts provided to a local government by a business or practitioner for the purpose of determining occupation tax liability is confidential and exempt from the Open Records Act. Violation of this confidentiality is punished as a misdemeanor. However, information on gross receipts received from a business provided to one local government for the purpose of determining occupation tax liability may be disclosed to another local government for occupation tax purposes, pursuant to a court order, or for the purpose of collection of occupation tax or prosecution for failure to pay occupation tax. Current law seems to permit local governments to access state tax returns for occupation tax purposes. Specifically, the Commissioner of the Department of Revenue, as well as each tax receiver, tax collector, and tax commissioner in Georgia, may furnish to the tax officials of any other state, political subdivision of any other state, political subdivision of this state, the District of Columbia, or the United States and its territories, any information contained in tax returns, reports, and related schedules and documents filed pursuant to Georgia tax law, or contained in the report of an audit or investigation made with respect to any tax return, report, schedule, or document, as long as the jurisdiction to which the information is furnished grants similar privileges to Georgia, and if the information is to be used only for tax purposes. If a local government's revenue from occupation taxes exceeds the occupation tax revenue collected the previous year, the local government must hold at least one public hearing as part of the process for determining how to use the extra revenue. When planning and implementing occupation taxes, local governments may not divide a business into its constituent parts and impose a separate occupation tax on each portion of the business, except with respect to businesses with more than one type of service or product. Local governments may not levy occupation tax on more than 100% of the total gross receipts of a business or practitioner. Local governments may not determine taxation by the size or square footage of the office or location. Local governments may not require payment of a fee by a business or practitioner for the cost of determining if that business or practitioner has paid occupation tax to another local government. And local governments may not use any criterion other than those specifically authorized to determine the amount of occupation tax to levy on a business. A regulatory fee is a payment required by a local government to fund the government's regulation of an occupation, profession, or business. Local governments may not require any type of fee other than an occupation tax in connection with the regulatory fee. Local governments may not use regulatory fees to raise money for general purposes. Moreover, a regulatory fee may not include an administrative fee or registration fee. Georgia law allows local governments to impose regulatory fees on a business, quote, only if the local government customarily performs investigation or inspection of such business or practitioners of such profession or occupation, end quote, in order to protect the public health, safety, or welfare, or in an effort to enforce a state or local building, health, or safety code. Since local governments may regulate a business in order to enforce a state or local building, health, or safety code, a building permit required by a city may be permitted as a regulatory fee as long as the city provides a regulatory service in accordance with any fee charged. However, a city should not charge a fee for a building permit if the purpose of the permit is for registration and notification, rather than an opportunity for the city to inspect building plans or actual construction work. Note that regulatory fees do not include development impact fees or other fees related to zoning or land development. Local governments are authorized to provide by local ordinance or resolution for the imposition and collection of regulatory fees on businesses and practitioners of professions and occupations that do business in the local government's jurisdiction. An ordinance should include procedures for the imposition and collection of these fees. The ordinance may also provide for the punishment of a violation of the ordinance or resolution. Local governments may not classify businesses on whether the businesses have a location in the local government's jurisdiction and impose different regulatory fees on the basis of this classification. Georgia law provides a non-exhaustive list of examples of businesses that may be subject to local government regulatory fees. These examples include the following: building and construction contractors, taxicab and limousine operators, pawnbrokers, food service establishments, nursing and personal care homes, landfills, hotels and motels, health clubs, and locksmiths. The law also contains a non-exhaustive list of businesses upon which local governments may not impose a regulatory fee. Businesses on this list include the following: lawyers, chiropractors, dentists, veterinarians, public accountants, motor vehicle dealers, and any other business, profession, or occupation that is required to be licensed or registered with the state, unless the state law regulating the business, profession, or occupation specifically permits local government regulation. Georgia law expressly exempts the following groups of people and organizations from paying regulatory fees: disabled veterans of war or armed conflict, blind persons, veterans of peacetime service who have a physical disability which was incurred during that service, a local board of education, and any state or local authority, nonprofit organization, or vendor acting pursuant to a contract with a tax-exempt agricultural fair. A local government's regulatory fee ordinance should provide guidelines for the payment of regulatory fees. Under Georgia law, regulatory fees must be paid before commencing business as a condition precedent for transacting business or practicing a profession. Regulatory fees may be paid after commencing business or the practice of a profession when the work done or services provided are necessary for the health or safety of one or more individuals, the work done or services provided has no adverse effect on any other person, and regulatory fees are tendered to the local government within 2 business days after commencing business or the practice of a profession. State statutory law, as well as recent state case law, limits the dollar amount of the regulatory fee that can be imposed on a business. Georgia statutory law mandates that any regulatory fee imposed by a local government must reasonably approximate the cost of the local government's regulatory services. Specifically, the law requires the amount of a regulatory fee to, quote, approximate the reasonable cost of the actual regulatory activity performed by the local government, end quote. Thus, it is imperative for each local government imposing regulatory fees to be able to determine the cost of the service it is providing and to assess its regulatory fees accordingly. Again, local governments may not generate revenue through the imposition of regulatory fees.